It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, or good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live stream, Series 18, Episode 4 in the aggregate. That's Episode 106 start here. And let's kick off with a bit of news from the home team, Exchange Invest, the Bourse Business newsletter, which I publish. We kicked off our 10th anniversary celebrations this week, a decade of Exchange Invest, which harks back to a time when they were just planning to launch LME Clear. Poland's KDPW and Russia's NSD were planning much more fundamental CSD cooperation. PLW Pith was evident too, as I noted in issue number 1. Competition, like opportunity, remains everywhere in this space. How true that is to this day. Meanwhile, the London Stock Exchange Group, they have set up an MOU. They're going to be establishing a tech center of excellence in Hyderabad. That's, of course, the case where they are setting up a center of excellence in Hyderabad. They already have a center of excellence with 600 people in Bucharest. They're looking to add another 1,000 people in India. They've got countless people in Sri Lanka, although, of course, at the Millennium Plant, what we know is that parsimony has led to a huge exodus of people. And more significantly, ladies and gentlemen, only Exchange Invest brought to your attention this past month the fact that there is no longer a sales operation for the technology for exchanges, clearinghouses, and CCPs and CSDs within the London Stock Exchange Group. Heaven knows what's going to be going on at the new Centre of Excellence. In Hong Kong Exchange, and indeed in Hong Kong per se, two great announcements this week. First of all, Hong Kong exchanges will soon produce rules to enable trading on Typhoon days, and ICE Singapore can accept Hong Kong clearing members. That came in the same week, of course, May 15th. We had the great launch of, finally, Swap Connect is live all the way into mainland China. Watch that renminbi yield curve trading in Hong Kong in the near future. Very, very exciting times throughout Southeast Asia. Meanwhile, at the CME, the Chicago Mercantile Exchange, they had a modest kerfuffle at their AGM. Support evaporated for executive compensation, and shareholders nearly removed the chair of the Compensation Committee, Charles Carey, from the board. Charles Carey sweeping home, well, not really, actually, just about sweeping home. 156 million votes got him onto the board, but there were 130 million against his position. Pretty much a tight mandate of just 54%. And meanwhile, that vote on the individual compensation, that was not carried. Only 91.5 million votes for and nearly 193 million votes against. On the other hand, let's look at something positive this week. And actually, we had thought a long time ago, perhaps we could mark the 10th anniversary of Exchange Invest with a very positive, upbeat speech about the parish of exchanges. Well, actually, if you're going to watch one thing this week, ladies and gentlemen, other than, of course, IPO-VID with the wonderful guest today, Jeff Carter, go and check out on YouTube the inspirational American University AU commencement address by Adina Friedman. AU, of course, is also the symbol for gold. And this is a speech that is pure gold. A fitting inspiration about life, markets, and our many exciting prospects, all based around trust at the epicenter of financial markets. Good work and congratulations on the honorary degree, Dr. Friedman. Our guest today is Jeffrey Carter, our topic from the Merc floor to angel funding. Jeff Carter knows his key strengths include being innovative, strategic, transparent, and knowing how to get the edge. He took the ethic from the trading floor of my word is my bond and brought it into practice with early stage investing. Jeff is a partner at early stage VC West Loop Ventures, an early-stage VC fund that invests in B2B Fin Tech companies and was the driving force behind HydeParkAngels.com, the most active angel network in the Midwest. Jeff was an independent trader at CME for over 2 decades. He was a member of the CME Board of Directors back when I first met him, actually, and he had an active role to play in the remaking of the member mutual into a for-profit public company as an active member of the Strategic Planning Committee, and he chaired and co-chaired several committees during his time as a member of CME. Jeff, great to see you today. Where in the world are you talking to us from today?
Las Vegas.
Gosh,
Las Vegas, baby.
Speculative hub, not so much for risk transfer, but pure speculation.
That is for sure. I think the best statisticians in the world actually reside here in Las Vegas. I was watching a hockey game the other night. The Golden Knights, of course, are in the Stanley Cup playoffs, and the over/under on goals in the game was like 6.5, and there were 6 goals in the game with like 5 minutes to play. These guys are uncanny. They should be trading. They should be writing algorithms maybe or something like that. It's weird that we've known each other. You said decades, and so that just means we're old, I think. It's weird. I got my CME gratuity fund thing that my friend Jimmy Olaf used to run, and it shows the Merc members that had paid in that had died, and I'm starting to know like more and more of them, and that's kind of a melancholy thing to get in the mail.
That is rather melancholy as you go through those sorts of people passing away around you. Yes, it's rather a shame to see, and certainly amongst male mortality, it starts getting quite serious, which is really not entertaining at all. But anyway, I mean, talk to me. How did you get to work in the CME? What drove you into finance?
I have a classic Chicago story of going down there. I used to tell Washington politicians that that the exchanges in Chicago grow locals like farmers grow corn. You knew somebody, and in my case, it was my high school football coach who had gone down there and done really well, who his brother had gone down there and done really well, and really bunch of his brother's friends from Oak Park, Illinois, John Wilkin and Billy Higgins and Gary Zerfoss and Dean Rogers and Michael Perry. You could just list scads of them from Oak Park that went down there. And so Orv brought me down when I had dropped out of the Air Force Academy. He says, don't go back to college, just come back here. And I looked at the floor and I thought, this is for me, but I got to get a degree. And I was literally in a bar in Chicago where one of my friends might have worked for some Italian people paying and collecting on Thursdays. And Orv walked in, and he was a big football bettor. And he asked me what I was doing. And I told him, and he said, I'll have you making $100,000 a year in 3 months. Quit your job. So I quit my job, and I made $150 a week for 3 months as a runner. But and my desk guy that ran the desk told me I'd never make it. And, the rest is history. But it was, the most rewarding experience I ever had in my life. John Lothian, who, calls it, 5,000 people that couldn't be employed by anybody. And that's probably accurate. It was herding cats every day. Every day was a new day. But the people that I met down there were incredible people, incredibly brainy people, incredibly analytical people, along with people that shot from the hip. So it was all comers, all kinds of people, and you had to survive in that environment. And it taught me a lot about myself and about survival. And you're able to translate that to real life if you can do it.
It's so interesting. I mean, that's a great quote from John Lothian, actually, because yes, the floors had this amazing melange of people. I mean, I always talk about Paul Gallico when he was a novelist, because when he was a famous novelist, he still used to go and report in Saturday night ball games for one of the New York papers, and everybody was saying to him, why are you here? You're a novelist. You don't have to be here. And he would look around and literally with, hot dog ketchup being smudged on him by people left, right, and center. And he'd say, but all human life is here. And that's always the thing that I'm very keen to point out about markets. And certainly when you went to the Merc floor, all human life was there in every possible respect.
It was an incredibly entrepreneurial place.
Yep.
And so you talk about markets. I'll tell you two quick stories about markets. There was this guy named John Bailey who became a mentor of mine. His badge was JBS, and he was in the Eurodollars, and he was a huge trader. And John said, I want to retire. And everybody was like, well, what's going to happen? Who's going to make markets in these markets that he makes markets in, and these double butterflies and all this exotic crap that he traded? And the day he left, there was somebody there to make markets. And so, that's what people don't understand about markets. Holes get filled very quickly. Then I went to University of Chicago to get my MBA. And the great thing about Chicago was it took all this stuff that I had learned on the floor and quantified it mathematically and proved what I knew in my gut. And so I had a professor there who told me, people don't think it's true, but the most innovative sector in the economy in the world is the financial sector. And it's because of markets. And they're just fascinating things. I love free markets. I love educating people about free markets. And dangerously today, we have a lot of people that don't believe in free markets. And there's reasons for that, but they're wrong. And, I can't be any more blunt than that.
Well, it's so interesting. I mean, you can't be any more blunt about it, but it is true. I mean, it seems incredible to me that we have this internet, and everybody who uses the internet every day, they use an exchange. They may not realize they use an exchange, right, but the backbone model of e-commerce is the exchange. Because when you use Uber, Amazon, eBay, whatever, Airbnb, it is all an exchange model. And this is the thing that always has driven me mad. And I've probably said this many times this show, because you, like me, have gone to a million startup conferences, and we'll get there in a minute. But you always have that person who stands up and goes, it's amazing. Airbnb, they don't own a single property. And Uber, they don't own a single car. And it's because it's an exchange. I mean, it's the most perfect means of allocating capital to work, to product, to demand that the world has ever seen. Right. And yet we have all these people who go, well, markets don't work. And you go, well, hold on a second. You got up this morning, you probably ordered via an app to get something delivered to you, which arrived at your door from Amazon. As you were picking that up, you probably collected an Uber, or a scooter or whatever. And it's just so crazy. It's infuriating, actually.
It is. It's infuriating. And when you get right down to it, and I think the other thing that's infuriating to me is, well, free markets don't work. They need to be regulated. And the funny thing is, if you read this study, and I can't remember who wrote it, but it was an English economist that was shot down in World War II. And it's called The Economics of a POW Camp. And it talks about how a market economy came out of nothing in POW camps in Germany and flourished. And then when they regulated it went away. It was so big that somebody needed an accountant for their coffee stand because it was just so wild. And you had people trading with other people, and because they had free will, basically, inside this little microcosm of a POW camp, and no regulation, they were able to have gains from trade. And humans are wired to do that. We've been wired to do that ever since, God put us on this earth. And you can't go against human nature like that. And I think the people that are anti-free market are going against human nature. The only way to put that sort of system in place is at the tip of a spear, and put the people like you and me in gulags. So, and it doesn't work still. So,
but it's fascinating. I mean, you're talking about that. I think the paper was it R.A. or J.A. Radford? Something like that. Radford was the economic organization of a prison camp. And it's very interesting. It was published in 1945, just after the war, one of the first economic papers. And yes, it's incredible to see how that goes on. It also reminds me of a great story about one of the leading bankers in China who was sent for re-education in the Cultural Revolution. And they said, did you not find that horrendous? Because, I mean, literally this guy was still in sort of his suit that he had been working in the bank, and they'd lifted him and he was in a rice paddy somewhere. And he said, well, even though it was communism, I knew that economically it wasn't going to happen because, and I love this statistic, in the Cultural Revolution, you still got paid whatever was your prevailing salary when you were being re-educated. So this guy was on, okay, VP of the biggest bank in China was not VP of the biggest bank in the USA today, but it was, he was standing there on 10 or 20 times as much money as the guy next to him, who was quite literally a hawker or, a painter or something. And he said, I'm just sitting around here and I'm thinking, wow, this whole thing's going to collapse in like 2 or 3 years because they're going to realize that actually they can't afford the Cultural Revolution.
That's right.
I also, that was a great statistic, but there's a very interesting point about Radford. And I mean, it's interesting. Let me just go to the audience. Hi, audience. John T, good evening, all. Good to be here. Delighted you could join us. We're here talking to Jeffrey Carter on the very exciting topic of going from the Merc floor to angel investing. Similarly, Matt Timms, it's lovely to have you with us today, Matt. Thank you very much. Good evening, Patrick and Jeff. Ladies and gentlemen, if you're watching this evening, don't forget to send us a little bit of love. We would really appreciate that, because love powers AI, and AI powers us up the charts, and therefore more people get to hear about markets and what the good they do for people, the more statistical love we get. So give us a little heart as you're going along. Thank you very much. And actually, we've got an interesting question from John T. Let's just jump into that. Do you think that the advances in technology have actually increased the greater innovation in financial markets compared to the past?
I think it's made it faster. I think what really drives innovation is competition. And so technology has made markets more competitive. The fact that there's more access to markets, I mean, at the Merc, we kind of had a little club on the floor and we opened up access, and now it's more competitive. And that drives innovation. So I think it's really competition that drives innovation, not technology per se. Technology just makes it faster, enables it to scale faster, enables it to put, tools in the hands of more users faster, so that they can, that increases the level of competition, frankly, because, if you think about arbitrage, you can arbitrage a market for a while, and then it goes away if it's a competitive market. And then you have to figure out a better mousetrap. So that would be my answer to John's question.
Thank you very much, John T. Yeah, technology an enabler. It helps facilitate things, but ultimately it's human ingenuity that gets us going somewhere. And that probably would lead us to a ChatGPT question very rapidly if we got there. But tell me, so you went onto the floor. Talk to us about that. You got 5,000 people, predominantly men, all around you. You're trading all sorts of things. How did you find the pit, the market for you, and how did you get underway trading?
So for me, I came from a middle-class family. My dad was a teacher. I knew Orv, but I didn't really know anybody. So I had to network around, which was great for me when you think about it, let's say 30 years later, when I had to network around the angel space. I had already done it. It also afforded me the opportunity to meet a lot of people on the floor. When I ran for the board, people knew who I was, because I had networked around. My first job was with a guy named Roger Carlson, who you know well. Roger backed me. I was his 5th employee. I was a clerk. I clerked for a guy named Dave Vecchione. He and I are still friends today. Vec is a great guy. He's a great follow on Twitter. And I loved working for Roger. He gave me the capital to trade. And as a matter of fact, John Bailey, the guy that I mentioned previously, he said to me, he said, Jeff, he said, you're too good a trader to work for somebody else. You got to work for yourself. And I said, I don't know, blah, 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 blah. And Roger, I talked to Roger about it. And Roger worked out a way for me to work for myself and leave him amicably. I love Roger for what he did for me. And always indebted to him. But Roger helped put me on a course where I could be successful. One day, for instance, I was trading and I took a shot ahead of Fed time. I lost $25,000, and I went up, and he was behind his desk, not trading at the time. And I said, hey, I got some bad news for you. And he said, he looked up from his desk, and he looked at me, and I said, I just lost $25,000. And Roger said, oh, he said, keep trading. And, didn't bat an eye. So when I proceeded to lose $350,000 in one day because of the way Roger educated me, I could absorb the hit, and I kept trading. And I kept trading until I couldn't make money anymore. And the reason I couldn't make money on the floor was the transfer to electronic trading. And I was one of the guys that was unable to really make the switch. I had lost my edge. It's not like I was, bagging orders or anything on the exchange, but I had a speed advantage that nobody else had. And once that speed advantage went away and the markets became thinner, you couldn't lean on orders or anything like that. I was a big spreader. And then the spreading algorithm took away all the edge too. So it kind of put me out of business. So I had to figure out something else to do.
So yeah, I mean, that was a traumatic time, and fair power to the CME. Obviously, we were talking to Jimmy Olaf just a few weeks ago. That's a great show, actually, ladies and gentlemen. If you haven't seen it, go watch it. All about really one of the men who was absolutely pivotal in driving the CME into being a for-profit company and driving it electronic.
I would say, I would echo that. I think Jimmy is very understated in what he had to do. I can still picture him in his office smoking cigarettes and seeing all the model football helmets behind his desk. We had lots of conversations, and Jimmy really, Scott Gordon but Jimmy drove the strategic planning committee.
Yep.
And Jimmy was the absolute right choice to do that, given, what people don't understand is in member-run exchanges is very political. If they think Democrats and Republicans in the United States fight, you should see people fight over pit space. So Jimmy was on the broker side, who didn't want the change. He was part of that side, and I was part of the other side. And we had a great relationship. And it was really Jimmy that drove that relationship with me, because he knew that, it was good. There were things that were going to be adversarial.
Yeah.
But Jimmy asked the right questions. He asked them in the right way. And he doesn't get enough credit for what he did to drive that train. And I'd say that to my grave. And I think other people would echo me in that too.
Yeah. I think that's been quite interesting, actually. My mailbox has been huge in recent weeks since we had Jim on the show, because everybody's been writing in to say, thank goodness that somebody was giving Jimmy the accolades that he deserves, because he really was a pivotal figure. There were many people involved. Many people drove the Merc forward, but the things that he did were quite sensational. And his speech to that, what was it, the shareholders annual general, the seat holders annual general meeting, the members meeting, which really explained and laid out how the Merc simply was in danger of not surviving if it didn't embrace modernity.
For sure. And you could put it this way. We believe in free markets. There was a free market for seats on the floor. I paid, what did I pay? $580,000 for my seat in 1992. It went to 1.2 million in valuation. Seat leases were $7,000-8,000 a month or whatever, and everybody was fat and happy. In 1998, that same seat went down to 280,000, which was reflective of the future. So markets take everything that's known and price it into today's prices. Everybody thought we were going out of business. And so, if you bought one there, you had a great buy. But yeah, we were going out of business for sure. Nobody thought we'd make it.
Yep. Quite incredible. Amazing times altogether when you look at that. So the transition to electronic trading didn't work out so well for you, and that left you with, and I'm sorry, and it's ironic, because therefore I feel like I failed as well, because the one thing the Merc did under Jimmy's stewardship was to set up this digital center. They not only was it an electronic learning center, they even had people like me come along and try to teach people how to go electronic trading, at least try to explain the differences to give people some thought. And that was the only exchange that did it in the world. And it will forever to the credit of the Merc, not because it employed me some of the time, but just the fact that the Merc did that for its members.
It was a great effort. I think we saw London go electronic and how disruptive it was, and we were trying to ease the disruption and try to make it so members could survive in the new environment. But the fact is, a lot of us were used to the tactile human environment and didn't understand that you couldn't chase a market, didn't understand how stops worked in an electronic market, just didn't and frankly, in the early days of those markets, the volatility so if you think about it in terms of calculus, the volatility at any certain point in time in an electronic market is actually greater than in a human market. And so there's more variance from point to point. And I've seen actually I think a Northwestern professor or Stanford professor did a study on electronic trading and showed that the faster the market goes, within milliseconds, there actually is more variance in price than there is in a slower market, which is kind of interesting. And so I couldn't make it. And it was a very dark time for me. I've had, 15, 20 friends kill themselves because when the money dried up, things happened. When the money dried up, people got divorced. When the money dried up, they turned to alcohol, they turned to drugs, they turned to anything. The interesting thing, I think, with a lot of people, and I'm not talking about the people that made it on the floor, the people that made the switch to electronic trading they had something else going for them. They had, scads of capital, but they usually had either an information edge or the ability to absorb volatility in a different way than you did on the floor. The people that didn't make it went into professions. We were talking about this the other day with people that were self-directed and, didn't have a lot of employers. So like you see a lot of guys from the floor that are in real estate, or they become franchisees, or in insurance, or they're doing wealth management or something like that, where, you still eat what you kill. You're still sort of self-directed, but you're not working for the man. We just didn't have a lot of people like that.
And it always strikes me like real estate investment it's a bit like the difference. Real estate investment compared to the floor is a bit like the difference between athletics and Tai Chi. Real estate investment is kind of like the slow moving thing, but then it all suddenly happens. Whereas, and that's actually, I think that was the biggest difficulty for a lot of people. Was, I wouldn't say everybody had ADD that was on the floor, but they were used to everything happening bang, 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 bang. And the idea that, even the best property transaction takes days to close, if not weeks, and there's all sorts of issues. And people just go deranged, and then you have to sort of mess around in order to transform the value or whatever it's going to be, and that takes ages. And it's a totally different Zen state, which becomes very difficult.
You have to take what and understand that at the end of the day, you're not going to know where you stand. And you have to be a builder. So there were people on the floor like myself that were, builders. We would have done extremely well in Silicon Valley had we known how to program, but we could have been great business development people too. The one thing that I think traders have over virtually everybody, and I'm talking about back in the day, is just this insane competitive streak where they will get up earlier than you, they will work harder than you, they will do anything it takes to win. And you have to figure out a way to channel that energy and ethos into a different sort of occupation. And it's tough because you don't get the immediate gratification that you got on the floor. And so, you'll see it like on dopamine hits, right? So people get addicted to dopamine on social media, same thing on the floor. So everybody was kind of like that. But some of us made it, some of us didn't. I didn't, but I figured out a different way, and it was a dark time. It took me from 2009 to 2016 to really see the light of day. And in all that time, though, from 2007 to 16, I was making angel investments, and then we raised a very small fund in 2016, which now has sunsetted. The fund is closed to new investments, but it's doing quite well. And ironically, my partner was a computerized trader that had never ever seen the floor, that had worked for GetGo. So it was a melding of worlds. We don't talk about trading, but tell them
So
so
what got you? No, so it's interesting though. I mean, I'm fascinated. What caused you? I mean, what was the catalyst that you saw this opportunity in the startup angel investing field?
Well, there were a number of things that happened. Number one, when you were on a trading floor, because there was a concentration of money there was always some deal flow happening. I can remember my buddy invested in this train that was going to go around the world and do this bicentennial thing. I mean, it was a loser. Or somebody invested in oil wells. Everything was always a loser. It wasn't good deal flow, but it was deal flow. And so you had a risk appetite as an investor. The other thing about trading is if you're a good trader, you looked at the market, you looked at the macro market, you looked at the charts, you looked at all this, and then you had to make a gut decision, right? And then you had to put your money out there. And if you made money, you made money. If you didn't, you had to figure out how to get out and get out in the best possible way. With angel investing, of course, it's Roach Motel because there's no liquidity if you really do want to get out.
Yeah.
Then you had risk analysis and trading, like how much capital am I going to commit to this trade? Well, same with angel investing. What's my check size? What should it be? How much risk should I take? They're doing another round of fundraising. Should I press my winner? Should I put money in? Or is my money better allocated somewhere else? So you have all these similar sorts of decisions. The other thing that was fortunate in my life was my last 2 years of school, I went to the University of Illinois where they invented the internet. And I lived with a bunch of engineers. Well, those guys knew a bunch of people that were inventing the internet at the time. It was 1984. That's how old I am. But, the first internet browser was made there, Mark Andreessen. Yelp, Netscape. All these companies came out of U of I, and it was like, man, if I could have invested in those, I might make a little bit of money.
Right.
But the last thing that was fortunate, just very lucky in my life, was I went to high school with two of the people that helped to start up Intuit in California. And I heard these stories about, how, they'd done really well. Well, I was friends with them, and you check it out, and here they were, and you hear their story about how they started Intuit. And now it's a big public company, and yeah, they did really well, but they worked really hard and they took a lot of risk. And so I had all that, and I'm like, boy, I'd really like to do that. The problem was in Chicago, there wasn't really an efficient way to do that. So my choice was start it in Chicago or move to the Valley and try to join the herd. Well, traders don't like to join the herd. We can always do it better. And, we want to try to run our own show. So, and frankly, as we looked at it, I thought Chicago had a lot of potential. It was a magnet for every Big Ten university. You had a big population there. You had a lot of talent inside the city. You had also University of Chicago there. You had the Polsky Center, which was one of the best sort of college accelerators for startup companies around, with a track record to prove it. And so there were a lot of things there that could do it. Jack Sander invested in this one thing, I remember, and he was making a lot of money until it went broke in the internet bubble. But, so you had a confluence of things. And we, my classmates at Chicago Booth, Vishal Verma and Ryan Humphreys and a couple other people got together, and we said, we can do this. but they couldn't do it in Chicago because they didn't have the connections. I had the connections. And so we partnered with the University of Chicago to give us some credibility. And we introduced ourselves. And what was really funny at that meeting is, I can remember it like it was yesterday. Somebody asked me the questions, what are you guys going to invest in? And I said, we're going to invest in what makes Chicago great. Chicago's really good at certain things, better than other places. And they said, are you going to invest in like hardware and high tech? And I said, why would we do that? You could just get on a plane or a train or drive out to Silicon Valley and get money for that. You don't need to do that. We are going to invest in, fintech. We're going to invest in medical. We're going to invest in consumer products, things that made that city great, where there was a lot of people understood it. You had ready customers, and you had people that you could get employees too. And so we did that. And I'd say by any measure, Hyde Park Angels is wildly successful. It started in April of 2007. I built it with help from a lot of people to what it was, and it transferred ownership, and they're still around. Our first investment out of the box happened to be a card shuffler. And it seems like a really stupid thing, but it returned 19.5x. Simple Mills, one of the leading consumer products brands in the sort of non-GMO, gluten-free space, came out of there. Lots of companies have gotten funding that couldn't. And so I think, cockily or without a lot of humility, I would say Hyde Park Angels kicked off the seed stage investing boom in Chicago. Without us, it doesn't probably happen in the way that it did. And it's created a lot of attractive companies to work for there. I thought I really was comfortable doing angel investing. I really like it. You have to like it. You have to. There's a part of it where, in trading, you have all kinds of control until you make the trade. Once you make the trade, you have zero control over what's going to happen. And angel investing is like that too. So you meet two guys in a garage or two females in a garage, whatever. You can do all the diligence you want, but at a certain point, you got to write the check and turn over control to them. And even as a board member on a small startup, you don't have voting control. You don't have control. So you can input, you can suggest, you can cajole, but they're going to do what they're going to do. And so sometimes things go wrong. Best example I can give of how it all sort of works on a successful way is, I used to scour different accelerators for companies. So there's gazillions of accelerators all over the world. And I found this one company in a Techstars insurance accelerator in North Carolina that I kind of liked when I read their description. Got on a phone call with them, talked to them, really liked them, flew down there, met them in person, met other companies. Turns out I was right. I wasn't interested in any of the other companies, but I really did like them. Told them so. They came up to Chicago. I took them to their first baseball game ever. Turns out both these guys were from China. And I said, just as a side question, why the hell did you go to the University of North Carolina? Most people from China go to schools that are west of the Mississippi. And they go, we love NBA basketball. And there's a lot of NBA basketball guys here. So that was the reason they chose North Carolina. And so my partner really liked him. We had a 50-50 arrangement where if one of us didn't like the company, we could push what we called the big red button and not invest. And so we decided to invest. We led the deal. We invested, I think, $700,000 in their seed round. And another VC firm out of California who was absolutely great to work with invested. They launched and COVID hit. Right. And COVID put them out of business. I talked to them and I said, how's it going? And they said, we've lost our entire top line revenue because of COVID. They were doing insurance for Uber drivers, and they were doing some other stuff in that space, income insurance and things like that. And so I said, look at, and this is where as a cool-headed trader, you have to reach into when the market goes against you or whatever, when all hell's breaking loose, you stay calm. There's times to lose it and there's times not to. And I think great investors are good psychologists. And so that carries in the stock market and the futures market. It also carries in angel investing. And so, I had a guy here who had lost his entire business. He was afraid of failure and he didn't know what to do. And I said, look, we invested in you as a person. We think you're great. And you are going to figure this out. How much money you got in the bank? He told me, knew the runway. We knew the burn rate, had that figured out. Okay. We know our time when we got to figure this out. I think we could do easily another investment in a convertible debt note at this price, which will carry you more. And I'm sure the other investors be in too, because this COVID thing is stupid and it's a rare occurrence and it came out of the blue and we'll figure it out. So sure enough, he figured out a business. He raised another round of venture capital from First Round Ventures, and he raised another round with Lightspeed. They're going gangbusters. The company's growing. I don't know how many employees they have now. I'm not on their board, but I still talk to them. And they're doing really well. And so that's an example of things that could happen. And it can be really lucrative if you invest right. It can be painfully debilitating when you invest wrong. So
right.
You have the scars to go the other way too, and I can tell stories about that. But,
well, it's one of the things I was thinking about startup investing and angel investing is that in some ways it would be so much nicer if your losing trades went bust quickly because you'd have much less pain. But it seems to me so many of them take such a long period of time. They quite often die slower than the average opera singer in a 19th century French opera.
So there's zombies like that, but what I found is your bad investments will die within 2 years.
Right.
Your good investments take 5 to 15 to pay off.
Right.
So then, you go to, let's say you're going to raise a fund and you've been angel investing for 3 years and somebody says, what's your track record look like? And you're like, well, I've got these guys that look really good, but they haven't exited. And I've got, these 3 over here and they died. And the guy's like, wait, I don't think you can do this. I mean, I had a company where I was the absolute first check-in. They were going like gangbuster crazy. They signed a term sheet with a big venture outlet at a valuation that I thought was absolutely insane. I think it was almost $1 billion. I was in it like 4 or 5 million or something. Right. And I'm in my head counting my money, talking to the guy, and I'm like, hey, can anybody want to buy some stock here? Because I'll sell. And because I knew the valuation was way ahead of itself. Well, turned out the stock market tanked and these guys pulled out and then the company wound up going bankrupt. So That's what happens with, some of your winners is until they actually exit and you ring the cash register, you can't count them. And the stock market definitely affects what's going on in the underlying private markets. Mm-hmm. And you saw that last year. So when the NASDAQ fell out of bed and the stock market fell out of bed, it may not have, because these things only price every so often, like real estate.
Yep.
It didn't show in your portfolio, but if you weren't intuitively marking down things, you weren't doing a good job for your LPs. And so our portfolio for sure took a hit, but I think our fund is probably up 7.5x or something like that. We made 8 investments and, nobody's gone out of business yet. We've had some exits. We've got a couple companies that are just absolutely crushing it. And that's just the way it goes, right? It's the power law of venture for returns. So
fascinating. And so tell me, I mean, when you were in angel investing, I imagine there wasn't one single playbook, but you've mentioned the idea of doing like convertible debt notes and so on. I mean, when people come along to do sort of seed rounds and stuff like that you were active in, what was there a particular kind of valuation metric, or are there particular valuations around to this day, or did you choose to buy equity or do something that was a little bit funkier?
Yeah, so I've done everything. I've done priced rounds, common stock, preferred stock, convertible debt note, safes. What I would say is investing in, capital finance in startups is no different than operation strategy or marketing strategy. It is, you want to build a vertical line up and to the right. It's momentum that builds on itself. And so when you come out, the valuation of a company is a dark science, right? It's out of Harry Potter. We divine it, boom. There are no numbers in the world that can support, let's say, an $8 million valuation for two guys in a garage doing something with $10,000 a month in revenue, right? The simple fact of the matter is you got to come up with a number. Now, that aside, numbers are numbers, and there's demonstrably factual numbers that you can look at. So if I invest in a startup of over an $8 million pre-money valuation, my expected IRR is about 20%. If I'm under 8 million, my expected IRR is 40% or something like that. In the startup space, it's going to take a certain number of rounds to get to exit. So you have to have a conversation with the entrepreneur about what type of startup they want to build. Do you want to build a startup that sells for $50 million? Do you want to build one that sells for $1 billion? Because there are two very different companies. There's very, very different financing schemes, very different ways about going about it, and very different expectations. And so you got to have those conversations with entrepreneurs at the very beginning to set expectations, and then you follow through. And so what we in angel investing is different than fund investing. In the fund model, we would have very hard conversations with entrepreneurs about stuff. And then we would tell them, look, we need to have this sort of ownership percentage at seed because we're a small fund. We're not going to be able to invest past Series A. And we expect it to have this many rounds. We're going to get diluted 60 to 70%. And right. Every check we write as a fund into any company, we expect to return the entire fund.
Right.
So this is how that math works. And we would show them the math, and you can't quibble with it because it's math, right? And so really all we're talking about is valuation and the future of the company. And that's, if we were perfect at predicting that, macroeconomists would, be like the most prized specimen in the world. They're always wrong, right? You're always wrong. Yep. But you got to start somewhere. So that's the way I looked at it. And then once I wrote the check, I would do everything in my power to support the company. There's an exchange you should actually take a look at. And your viewers, because they're in finance, might like this. It's called bitnomial.com. They're based out of Chicago. Luke Horston started it. He was at Alston Trading. And it's the only DCM in the entire world that can deliver physical crypto. They trade futures on crypto, options on crypto, and their contracts are set up for delivery. So there's a first notice day, and you actually get this much Bitcoin in your account. You hold it to expiration. It's not cash settled, unlike the CME futures. And so it's very different. And, I've helped him find employees. He's doing things that nobody else is doing. It's a really cool company. And so that's what you have to do as an investor. Once you get in, you have no control. So you have to be like Gilligan. You're a support person. You're not the main event. You're not the main guy. You got to put your ego aside. And all you do is kind of help them problem solve. And you ask good questions. I think as I've done this longer, I ask better questions. I understand it better. You get better as you go along. One thing that my MBA did do for me was it gave me the confidence and chops, at least, to analyze a business.
Mm-hmm.
Where before I had it, a little bit, but this really sharpened my skill. And then as an investor, you have to know what you're good at and what you're not good at, and be honest about that. You can't be a jack of all trades. You can't do this. You can't do that. And there's certain things I am really not good at. And so when somebody asks you for help with, can you help with, like, for me, operations? Can you help with operations? I'm like, forget it. I'm not your guy there. I'll try. I can know people that are good at it, but I'm not that guy. And so you have to be really humble about that. And those are the best investors, I think, are truly humble. I think, politically, I don't agree with Fred Wilson probably at all, but I think he's one of the greatest investors out there, and he brings that ethos to it. And when you look at his track record, he's pretty goddamn successful. So he's not all hat, no cattle. He's all hat with a lot of cattle.
So tell me, one interesting thing, you mentioned Bitnomial there, and that's a very interesting business.
Yeah.
You obviously, you were at the Chicago Merc when, good grief, I think when you joined the board, am I right in thinking the valuation of the whole company was like $1 billion or less or something like that? And less.
100 to 150 million.
Right. And it had basically nothing in the bank. 5 million or something in the bank.
25,000.
Wow. It's just incredible to think that was the case of it, and it's now worth a mere 70 something billion or something.
Well, we were a nonprofit, right?
Yeah.
Yeah. You'd get to October, if you hit your number, it's like, okay, commissions are free the rest of the year. Yeah.
And everything's fine. I know it's quite incredible to think about, but you saw the power of the exchange model explode with the for-profit exchange business and so on. Did that give you any impetus towards investing in exchanges, or did you just simply not see the opportunity?
No, I've looked at lots of different exchanges. The only one I've done a couple. But what's interesting about the exchange space, especially with the rise of crypto, and frankly, I didn't see, let's say, FTX, or I didn't see Binance, or I didn't see a lot of those exchanges. But the ones that I did see, my first question out of the box was, what are you going to do about clearing? And if they looked at me blankly, I knew I wasn't going to make the investment. Because that's the most important thing, right?
Yeah.
And when you match trades, you can download anything from the internet that'll match trades for you. So your trade engine, everybody wanted to show me this fancy trade engine. I'm like, I don't even care about that. That's easy. What's hard is clearing and settlement and pays and collects, and how are you going to do this? And, what are your rules? What are the rules of the road and all this stuff? And the very first meeting with Luke, he had answers to that question, and good answers. And the guy's a great, he's just a really good entrepreneur. We invested in open finance, and it didn't start out as open finance. It started out in the real estate space. And they became, still to this day, I believe, the only exchange to get through the SEC thicket and become approved to trade security tokens. We got through that, tried to list security tokens, found out that the Ethereum cost of gas was screwy for us. And then the SEC kind of put the kibosh on doing it, so we didn't have a business. But we still sold that business and didn't lose any money on it. So that's how valuable that license was. So, I think you can invest in exchanges, and then people will show you something. This is an exchange model. Is it really an exchange model or not? How do you create liquidity? Well, I always say you have to have natural buyers and natural sellers. When you think about corn, right? There's natural
Yep.
buyers and natural sellers, and then you got to get speculators in there and blah, 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 blah. But I understand market structure probably better than 99% of the people out there investing in exchanges. And I think I know how to ask the right questions. So I thought when FTX exploded, and then I heard the podcast with my friend Terry Duffy, and he said, how are you going to clear? It's exactly the question I would ask FTX. And he kind of gave some bullshit answer. And Terry looked at him and said, you're a fraud, which is perfect. It's so Terry, and it was exactly the right thing to say. Well, I don't think that a lot of the VCs that are out there right now are asking those kinds of questions because they don't have the experience like I do in the exchange world to ask them.
Yeah.
And so when you don't know what you don't know, you can't ask the question,
Yeah. I feel the same way. I mean, I think there's a huge opportunity out there for building new exchanges and new exchange investment. But what I see all the time is a total misunderstanding of what are the things that actually drive the success or failure of exchanges, which is a fundamental problem. Right. So, Jeff, I mean, I'm mindful of the time. We've been gliding through this hour so beautifully in every sort of way. And let me just say, thank you, Ian Miller. Hi, both of you. Good to hear your IPOs, Patrick. Thank you. Interesting times in exchanges and cryptos coming up, one thinks. Yep, certainly going to be interesting times, I think, without any doubt there, Ian. Thank you so much for your comment. Jeff, we only have a few minutes left, so I'm going to ask you the question we ask everybody at this stage. Where do you think the capital market revolution goes next?
That's a great question. I think in the near term, the bigger players get bigger. So everybody hates the big banks. I think they get bigger, especially if you look at the collapse of Silicon Valley and stuff and the resulting knee-jerk reaction from government. It's just paved the way for them to get bigger. I think there's so much fear of failure and fear of risk-taking in sort of the regulation side of the market that they don't want it to grow and happen. And that's going to make the power players already more powerful. At the same time, when you have big, huge verticals like that, there are entrepreneurs that will attack them. And so they'll find ways to attack them. So, I think crypto is going to have a lot to say with it. I don't think anybody's built anything of note yet that's really great. I don't know where it's going to come from. I think what people have done that I've seen is they've taken analog processes that work in the existing industry and put them into crypto and have crypto around them. But they haven't thought out of the box about what it really means to have a decentralized network. So when you think about, let's say, centralized clearing, people really hate the Merc because they're able to charge for data. They've got centralized clearinghouse. Clearinghouse, though, really is a crypto type thing. It's just centralized in one place. If you think about the B share is like a token, right? So they could tokenize their B shares and, become a decentralized exchange, right? If they wanted to. It obviously doesn't behoove them to do that right now. I think you're going to see, because of technology and cryptocurrency and things like that, you're going to see markets become way more efficient, especially in supply chains. I think there's markets out there that right now function, let's say, in barter, or they're very inefficient, that are going to be made much more efficient, which is going to promote more gains from trade, raise standards of living. Things that are highly regulated today, like water, like electricity, when they transition to a free market system, will become more abundant and more efficient. I live in Nevada. Everybody's worried about water. If it was in a free market system rather than a highly regulated system, we would have gushers of water here, believe it or not, in the middle of a desert. It goes back to the Milton Friedman thing. If the government was in charge of the Sahara Desert, in 5 years, they'd be out of sand. And I think that's true. I think the hurdle free markets have is the fact that they appear rigged. There's so much crony capitalism out there, and there's things built into the market system through regulation or other factors that cause them to look rigged, or in fact, they are rigged. I mean, the LME and the nickel market is a perfect example, right? And so I think in the short term, I think we're not going to see a lot of startups come on the scene and blow it up, let's say the existing verticals, but in the long term, we will. The real innovation right now, and has been forever, is in the payment space. And that's because it's relatively unregulated and there's a lot you can do around it. So, I mean, even we have a company out of Ireland called Pipit Global, which is facilitating payments between immigrants and in London. So it's a very fascinating company. And Ollie's been a great entrepreneur, good Irishman. But you know, that's what I see. And I think eventually, I think India wins over China. I think centralized governments fall. And I think the next century is going to be the North American century, because supply chains are too risky now. And you're going to start to see stuff consolidate given the right tax policy in the Northern Hemisphere. And there's so many resources here, natural and otherwise, human capital too, that give it a big leg up over the rest of the world.
And on that note, good grief, there's a lot to digest there. Who would have thought that we would have started talking about the CME Merc floor today, ladies and gentlemen, gone through the economics of prisoner of war camps in World War II, and reached a stage where we're discussing the macro geopolitics of the world, all framed against the capital market revolution, having enjoyed a tidy conversation about the whole art of angel investing on the way through. Jeffrey Carter, it's been a pleasure to catch up with you today. I hope you enjoy a beautiful rest of the day in Vegas. Next week, AFM, the Association of Futures Markets, they're going to be celebrating their 25th anniversary during the course of this year. It's coming up, their 25th anniversary conference in a few weeks' time. We've got their chairman and president, Pat Kenny, the chairman, Paul Constantinu, the president, coming up next week. That's going to be our show, which we're looking forward to, which will actually be on the 23rd of May, not the 3rd of May, as it seems to suggest. And I just want to say thank you very much, Matt Timms, John T., Ian Miller, for your comments and questions. And in response to your final remark of the evening, Ian Miller, I think PLY should just build an exchange. That would be the best idea. Send me checks. I've got some great ideas for you that can come together and make magnificent exchanges, Ian, without any difficulty whatsoever. Thank you very much once again to our guest, Jeff Carter, to our production team today, Natalie, Fernando, and Richelin. My name is Patrick L. Young. I wish you all a great week in blockchain life and markets. We'll be back same time, same place next week. Thank you very much for watching IPO-VID.